Hello, folks. Welcome to the mentorship. So, I think previously we talked about defining the high time frame institutional order flow, and we talked about looking at data, for example, to define the long-term trend in the markets. Then also we looked at technical analysis, the way we can use candlesticks, market structure, to define the high time frame institutional order flow via the drawn liquidity, right? And after we moved from there, we talked about validating the high time frame institutional order flow, because I think that progression only makes sense because once you can define the high time frame institutional order flow, or you have a perception of what the high time frame institutional order flow is, the next thing is, how do I know the market is responding to that, bias? Okay. And that's why we talked about validating the high time frame institutional order flows, so that when you have a bias, when you can frame the draw on liquidity, for example, you can look at specific details in price action so that you can, know that the markets are giving feedback, positive feedback, or probably negative feedback, or probably the markets aren't willing to trade in the direction of that draw. Now that we've discussed this perspective from the high time frame, because the first three modules were really talking about high time frame analysis and how to engage in those high time frame buys, right? So we're going to take it a little bit further down. That means we're going to go into the lower time frame. Although the kind of things we'll be saying today, we can mirror it into our high time frame analysis too. For example, because we want to talk about market profiles and profiling, right? We want to be able to look at markets and, we want to evaluate for high probability conditions primarily. And high probability condition doesn't only reflect on lower time frames, okay? It reflects also on a higher time frame chart, right? So when you're looking at the markets, when you're looking at the markets on the high time frame, lower time frame, whatever time frame, you want to be able to define if it's an environment you want to participate in, right? But before you can even define if the markets are in an environment, you have to have expectations first. Okay, we want to have expectations first. You want to see how markets are trading with respect to your bias primarily, right? And that's how you can now define if you can now evaluate for market conditions to see, are conditions favorable? Are conditions not favorable? Do I need to go in? Do I need to wait? And if I'm waiting, what are the key parameters I want to look for if I'm going to wait? Okay, what are the things I should be looking for if I'm going to be waiting? Because being patient is not arbitrary in trading. Okay, yeah, certain things you're looking for, and you're just patiently waiting for those things to form. Okay, and I think it might be a very conservative approach, but that's how you can be consistently profitable. Because if you always have a bias and you're trading off of bias, you're closer to gambling. Really, that's what I think. Okay, for example, I think say dollar index is gonna buy, because we are looking at dollar index from the perspective of the high time frame institutional order flow on the long term, and I just go in the markets and just buy. That's gambling, because there are a lot of questions you need to ask, and there are a lot of parameters that needs to be validated before you can say, oh, I think dollar index is willing to now expand in the direction of the high time frame institutional order flow, right? So let's circle back quickly and let's bring it back to the topic, that's market profiles and profiling. Now, if I asked you listening, what's market profiles and profiling? What do you think is market profile in your own understanding of price action? What do you think is profile? Well, obviously, I know I can't get the answer from you, but if you took a pause of the video and kind of like think about it, I can only, I would wonder what your answer would be, really. But if you ask me, okay, I'm going to say market profile just reflects the current market data. Really, that's it. Data. That's all. That's what market profile is, and that data is going to validate if a move is likely to, ensue. That's what the data is going to say. Because when you look at the market, you're looking at profile. And when we're talking about profile, there are about only two profiles. Okay, either the markets are in trending conditions or markets are in consolidations, right? Those are the only two distinct profiles. Okay, either we are range bound or we're trending. Okay, that's market profile. And when you look at the current market data, you can use it to determine if the markets are, are we in consolidation? Because if we're in consolidation, it means an expansion is likely to happen. And if the markets are likely to expand, what are those things in price action you want to look for that validates the markets are already in that phase of expansion, right? And if markets are expanding, you want to define where the markets are trying to reach for, okay, so that you can join and participate in the move. Does that make sense? So, for example, if you look at this chart, this is GBP/JPY on the daily time frame, and you can see that previously markets has been in consolidation. That's basically consolidation. Markets has been in this trading range, and markets left the range on this candle. Okay, now markets leaving the range on this candle already predefines that we are obviously out of this consolidation, and market is likely to reach for an opposing liquidity pool. But that's that on the side. That's just basic a technical perspective, just looking at the market and saying, okay, markets were in consolidation, markets have left consolidation. And I'm going to drop the annotations here, and we're going to see what it means when I say the market has left consolidation. What were the key parameters I was looking at in price action to say, okay, the markets has left consolidation. So that being said, if we say market profile is, the current market data, for example, and we use that data to validate if another move is likely to occur. So what's profiling? Profiling is more like a verb, like an action word, right? And you're using that data, for example, and it's technical data, of course. Okay, when you're profiling markets, it's not from the fundamental perspective of the market. It's technically based, right? So you're using that data, for example, okay, to determine what the markets are likely to do in a given period. And if we're talking about what the markets are likely to do in a given period, we could be talking about, what the markets are likely to do maybe in a specific time of day, or probably day of the week, or period in a month, right? So that's what profiling is. Now that we know what market profile is, it's basically the current market data, and it could be consolidation, it could be trending condition. And if it's in consolidation, you obviously know that the markets are likely to make a breakout and an expansion is likely to happen. And if markets, are in trending condition, you want to determine what the draw on liquidity is, where are the markets likely to reach for, so that you can participate in that move, right? So now, what are the key technical data, for example, when you're looking at market profiling? When you want to profile markets, what are the things you are looking out for? What are those key elements in price action that you want to, focus on? Now, the first one would be, the high time frame institutional order flow, or say the draw on liquidity, for example. And that's why, I took the mentorship from, looking at the high time frame draw on liquidity, because it's not from down up. I think the most ideal way to learn Forex will be from up, down, top, down. You get it's top, down. All right. And now that we have multiple lessons on the higher time from institutional order flow, for the fact that we do the commentary on a weekly basis, because that's very, very important. There's no lesson that will be taught here in this mentorship, and we're not going to give credence to the higher time from institutional order flow, or defining the draw on liquidity, okay, which is also the high time from institutional order flow, right? So what are the key technical data you want to look out for? First of all, was high time from institutional order flow, because that gives you a sense of bias first. Okay, like I said, when I started, I said you want to have that sense of bias. So when you look at the markets, you have an expectation, you know what markets are likely to do. You can manage the objective. For example, dollar index, we've been calling dollar index bullish now for weeks now, even if we've been participating on the bearishness, because apparently market structure still supports bearishness on dollar index as beginning of last week. Yeah, I think we had a draw on liquidity. If you check the commentary on the monthly fair value gap, the dollar index, that was a draw. So we saw markets and trending conditions, and we're just taking it one liquidity pool after the other, and that makes sense because in periods when market structure and the high time frame institutional order flow are diametrically opposing. Okay, we are seeing market structure say dollar index is bearish, but the high time frame institutional order flow is bullish. Then I said something. I said it means the markets are likely they are trying to reach for an objective. That is our job as technical analysts, to define what that objective is, and that's what I was saying. Once you can define market profile, okay, you see the markets are trending. Okay, even if it's against apparently the high time frame institutional order flow, we know when markets are moving against the high time frame institutional order flow, that's manipulation. Basically, that's manipulation. Even if you look at it on the high time frame chart, you look at it on an intraday basis, that's simply manipulation. Okay, so when you have a sense of bias through the high time frame institutional order flow, you have an expectation. So when markets are trading against the high time frame institutional order flow, you are very nimble with your objectives. Okay, you're settling for what's my objective will be: previous day's low, previous weekly low, previous monthly low. I'm not going to do something, arbitrary, something that doesn't make sense, because when institutional order flow is bullish and markets are trading below an old low, there's a possibility that markets could maybe make a turtle soup. Do you understand? And that's what it is. Simply, markets would make a turtle soup. So it only makes sense that whenever markets trades below an old low, I want to wait when market gets there. And that's still within the context of market profiling. Okay, we're gonna get there. So the second key detail would be key levels, because in as much as we can define the high time frame institutional order flow, we need to understand that how key levels of support and resistance play a role, in delivering markets to their respective objectives. And these key levels are simply the ICT PD arrays. Okay, we're talking about the breaker, the mitigation block, the order block, the fair value gaps, the old highs, lows, rejection blocks, and all of this stuff. Those reference points makes the PD array matrix. All right, and they play a role. Okay, they play a role in validating bias. They play a role in facilitating entries. You understand? They also play a role in framing targets, right? So key levels are an essential tool in technical analysis. Everyone knows that. I mean, that's basic technical analysis, support and resistance, right? So you know that these key levels play a role. So not just what the high time frame institutional order flow is, you also want to know key levels, and to be able to identify key levels. Not just identify key levels, you want to be able to utilize key levels appropriately, right? So the next one would be candle ranges. Okay, and candle range in the sense that the weekly range if you're a short-term trader, the monthly range if you're looking at it from a monthly perspective, or the daily range for day trading purposes, and probably you are a scalper or a day trader, for example, or even a short-term trader, because even if you're a short-term trader, you need to look at the daily time frame, right? You need to look at the daily time frame, because it's from the daily chart you'll be able to define if that particular day you want to engage is high probability, right? So each candle range is pretty important when you're trying to aspire key technical data when you're trying to profile the markets, right? And today's lesson is really going to center around intraday trading, okay? Because we've done a lot in terms of the high time frame analysis, because once you have the high time frame for long-term trading, pretty straightforward. You define the high time frame institutional order flow, you wait for market structure to validate the high time frame institutional order flow. For example, when you're looking at institutional order flow from a monthly perspective, you're looking for daily time frame market structure to validate the monthly buys. And what market structure are you looking at? You're looking for the change in state in delivery in line with your monthly buys. But if you're a short-term trader, you're trading weekly ranges, you want to be looking at 4-hour market structure to validate what your weekly buys. You can see the difference. when you're looking at the monthly perspective, you need the daily time frame to validate your monthly bias in terms of market structure. Although the weekly time frame will be seen as a single candle range, but inside the weekly candles range, it's daily time frame market structure. And that's why I taught market structure using candlesticks. Each candlesticks is like a compressed data of market structure. If you see a green candle, for example, in the weekly time frame, that's 5 days of trading. And on lower time frame, if you take it down to lower time frame, it will be a series of higher highs and higher lows and stuff, right? So that's market structure in the form of candlesticks. So while the daily time frame market structure validates the monthly bias, the 4-hour time frame market structure, if you a short-term trader, will validate your weekly bias. And also, if you're trading intraday, for example, you have a 4-hour draw on liquidity, for example, you can go to the 30 minutes time frame and the 15 minutes time frame to use market structure to validate your draw on liquidity on the 4-hour time frame, or even on the daily chart. Probably you're trading on the you have a daily draw on liquidity, for example, and you're now looking at market structure on the 15 minutes and 30 minutes time frame. When markets validate that daily bias at key time of day, of course, you want to go in. So that's how you can use time frames to validate high time frame bias, whatever time frame you're trading, and and that's about it. Okay. Now, that being said, I said the bulk of today's discussion is going to revolve around lower time frame, right? And since it's lower time frame, we'll be speaking a lot about the daily range. And because of that, we are going to talk about the average daily range. Okay, that will be an essential part of the module, because while you're profiling markets, for example, say Tuesday was bullish and markets ran about 45 pips, and Wednesday was also bullish and market ran about, say, 40 pips or 50 pips, and there's Thursday. Now you want to note that average daily range comes into play. I mean, back in the day, I think that was 2021, I used to use this model when I was trying to catch New York reversals. Okay, I don't do these things anymore because it's actually pointless for me. Okay, it's just risky business. So what I did was I always noted the average daily range for like 2-3 days, and I always try to look at the high time, say the weekly time frame, and see when the market hits objective. For example, if the market moved about 40 pips Tuesday, 40 pips Wednesday, and probably expanded to hit a weekly target on Thursday, and market has expanded as much as, say, maybe 45 pips, I know the average daily range is about 40 pips, right? And once they hit objective, I quickly rush to the lower time frame in New York session and look for a market structure shift and trade the opposing end of the weekly range. That's how I do it. Sometimes it happens on Fridays, sometimes it happens on Thursdays, but that's how I do it, right? And although, yes, it wasn't consistent, because there are periods when the markets can just continue just rallying and stuff like that. So I think that's one of the things that just discouraged me from doing that. And I'm like, why don't I focus on catching the trend rather than trying to trade reversals, right? Because it's riskier, and really, why? There's a lot of meat in the bone if you're trying to capture the trend rather than just trying to capture probably this kind of the rejection of the week. It's not. It seemed very basic. All right, so we're going to refer back to the average daily range, because talking about the average daily range has to be with respect to the draw on liquidity, of course, and targets and whatnot. So we're still going to talk about sessions, because that's one of the key parameters if you're trying to look at key technical data when you're profiling the markets. Like I said, market profiling is using key data to determine the markets are likely to determine what the markets are likely to do in a given period. And it could be a specific time of day, because when we're talking about time of day, you need sessions. Haven't you thought about it? A single daily candle. Okay, this is a single daily candle, for example, in GBP, JPY. This is a single daily candle. Now, these singular candlesticks, there are three major sessions. That's the Asian session, the London session, and New York session, right? Now, each of these sessions, it contributes to the daily range. I mean, when we were indoctrinated to smart money concept, the ICT smart money concepts, we learned about AMD, that's accumulation, manipulation, and distribution. And usually, what we learned was in the beginning period was Asian session is likely to make a consolidation. Okay, London session is likely to manipulate. Okay, and the New York session, or probably between London and probably New York close, we're seeing markets give us the range expansion. Now, do you know, when you look at the daily range like that, accumulation, manipulation, and say a potential distribution, that's market profiling, because you've profiled a particular session as consolidation and you've profiled another session that traded against probably your daily bias or weekly bias as manipulation. And when markets now validate your bias in terms of structure, you can now go in and expect the markets to give you that range expansion, which is the distribution phase, right? So that's market profiling. But that bar would be really, really low, because you and I both know that, especially this period of Donald Trump, the markets move overnight, the market move in Asian session. So what does it now mean for you in London session? And what does it mean for you in the New York session? Okay, and those are the kind of things, that's really the discussion we're going to be having today, because markets could expand in Asia, expand in London, and expand in New York. So your classic AMD, you won't find. Markets could expand in Asia, consolidate in London, consolidate in New York. Markets could expand in Asia, consolidate in London, expand in New York. Now, all of these things just depends on, number one, the draw on liquidity. Okay? And what's the draw on liquidity? Previous day's high, previous day's low, previous week's high, previous week's low, key levels and stuff. So, for example, markets, we're going to go through examples here. All right. Markets, you're expecting the markets to be bullish, and the Asian session was bearish, not in consolidation. The Asian session was bearish, making a retracement, but into a higher technical key level. And when markets trade into the key level, the markets consolidate in London session. Now, prior to New York, market structure now validated your bias. Okay. What are you likely to expect in New York if London session consolidates but shifts market structure towards the New York session? You're likely to anticipate an expansion in New York session. That's market profiling. Okay. And there are periods when markets trades overnight in Asia and meet a high time frame objective. What's the possibility that markets expand in London? That's very low, especially for certain types of pairs, because it's really not only about the session and all of those kind of things. It now depends on the asset you're trading. Okay, because one of those key technical data would be the asset class you're trading. For example, if you're trading gold is insane, literally. Okay, you would not compare gold to Euro USD. You wouldn't, because gold can expand as much as maybe 1,000 pips in a single day, 500 these days. On the average, it expands 600 pips per day on the average. So probably the Asian session move about 300 pips. You see, there is still potential for gold to expand more. So while you're profiling markets, you need to look at what asset class are we looking at? Are we looking at metals? Are we looking at stocks? Are we looking at forex? Okay, you need to put that into consideration, because if it's Euro USD, when Euro USD trades above a previous day's high or dollar index, whichever one, markets could literally consolidate for the rest of the day. And it doesn't mean you're wrong on bias, but you probably didn't put into consideration the fact that markets trade above previous day's high or low, and for that reason, markets will deal with you. I mean, that's what you're going to do. And it's pretty terrible, because sometimes you might just be coming off of another pair. Probably you traded the yen, because the yen are very expensive too. Okay, they move a lot. Like each daily range here minimum would be averaging about 150 pips. So you can see that because of that knowledge that the average daily range in this pair, for example, is like 100 pips. When GJ for example, moves about 100 pips and there's still a target it can reach for, you have that confidence based off of data, market data. This is data given to you by market, not me, that, oh, there's still possibility that markets reach for target because market hasn't met the average daily range and we still have my target. Are you thinking already in the direction I'm trying to talk about this? Because I said the reason why I have not dealt with this lesson, for one of the reasons was I wanted to, teach off of, charts that, I've probably uploaded on Twitter. Maybe I've talked about the chart so that when I'm discussing about it in the mentorship, it doesn't seem like hindsight stuff, and I'll show execution too, so that you see, oh, okay, this is why he did what he did. This is why he went in this way. This was his thought processes and stuff like that. Because aside posting chat on Twitter, really, I might not be able to really text and write every single thing and details because I'm actually a real trader. Okay, I don't consider myself an influencer, right? I don't. No, I wouldn't do that. In fact, it will hurt me if anyone thinks I'm an influencer. I'm not into that stuff. All right, so I'm actually a trader, and there's really no time. So I just drop the update, and everyone knows the tools and stuff, and that's why I've been consistent with the theme of my message. Okay, I'm being consistent with the kind of things I'm putting out and the tools I use in engaging markets, so that whenever anybody sees it, I don't need to say much. They already, because you've been with me for a while, and okay, I know what Shadow Black is trying to say here. Okay, he's highlighted this and that and that. Okay, this, okay, and stuff like that. Okay, and the final one will be the economic calendar, of course, because if you're day trading, because I said the majority of this lesson is going to center around day trading, okay, and you can't do anything without the EC, because sometimes the EC gives you a roadmap to when a move is likely to ensue. Okay, just take on the average and non-farm payroll, CPI, and the high impact news drivers. Okay, we know that markets are likely to move in this period, but it's not 100% because markets are not 100%. Nothing in markets is 100%. And that's why we can see the market expand in Asia, expand in London, and expand in New York. That's an outlier. We can also see the market make a consolidation. Okay, in Asia, make a consolidation in New York, and make a consolidation in London session too. We can also see the market expand in Asia, retrace in London, or consolidate in London and expand in New York. Probably it hasn't met the average daily range or its own daily objective or weekly objective. And we can also see the markets do the classic AMD, consolidate in Asia, manipulate in London, and expand towards the higher time frame general liquidity in New York session. Okay, and that's market profile. That's the probabilistic nature of the markets, and that's how I want everyone to think, that markets can move however they want to move, really. And what we are trying to learn, we're trying to learn price action for what it is, really. We're not trying to stay fixed to a particular price action. We're not trying to define a pattern we want to always trade. AMD, no, I wouldn't do that. And that's the reason why far back in 3 years ago, I wasn't trading the Asian range anymore. Friends that know me know that I don't use the Asian range on my chart. I don't even care about the Asian range. Okay, all I care more about is the key level. If the Asian range is forming above my key level, well, I might be trading below the Asian range, but I really don't care about the Asian range. I mean, for the fact that I want to highlight the Asian range and I want to see it as liquidity and stuff, or thinking when market crosses the Asian range, yeah, I must collapse all of my trades. No, I'm focused on my weekly buys. Okay, because if we're thinking like that, when I executed on GJ here, the early portion of this day, that was Thursday, was a retracement. That was during the Asian range. So it means when markets trade above the Asian range, I should have collapsed all of my trades. But no, I added new positions there because I really don't care about that. Okay, and of course, it's short-term trading. I'm trading off of the 4-hour time frame. After the 4-hour time frame still validated my weekly buys, right? So that's the key technical data for you to profile the markets. If you're not taking note, the first one again is the high time frame drawn liquidity, key levels, or the ICT PD arrays, and candle range. That's the daily range, the weekly range, the monthly range. And I also on the side talked about the average daily range. And we talked about sessions and the asset class you're trading, because he also gives, he also says a lot about the characteristics of a particular pair. Everyone talks about how, learn one pair and how the pair should trade and stuff like that. This is part of it, because when you trade a pair for so long, you already know the certain things this pair is likely to do. Okay, when Euro trades above previous days high, it's always crazy what you can do. Euro can literally reverse the whole range and return back to the previous day's high again. Very insane pair, very insane. So it demands a lot from you as a day trader to trade Euro USD. It demands so much from you, and that's why when I'm talking about Euro USD, I'm talking about from the 4-hour time frame. I can't deal with the disparity in knowledge online. It would be very difficult to do, and that's why I'm teaching this thing, so that when make posts online and you see some things, you say, oh, okay, he posted this, doesn't mean probably this is a setup here. This is low, I'll classify this as low probability. Then I can go in this and that. I mean, someone was asking me a question on Twitter yesterday after I posted Euro USD, and it was like, as day traders, what are we like? I said, I just explained market profile. Okay, we're gonna say it now. I was explaining market profile to the individual, talking about what's like. Okay, so wow, 3,400 following. Okay, that seemed very cool. all right. 666. Oh, that's very mystical. All right, someone asked the question, where are you? Yes, this is what he asked. Very beautiful question, really. It said, after a change in state in delivery on the 4-hour time frame, what should be the focus and expectation of a trader, particularly an intraday trader on the lower time frame? And this is what I said. I said the New York session, since the markets expanded overnight, London session is likely to stay in consolidation or make a retracement, right? The solution is to engage from the 4-hour as a short-term trader, because if you engage from the 4-hour time frame, you don't care about what London is doing. You don't care about what the New York session is doing. You're trading off of the 4-hour, you're putting your stop loss as an invalidation, and you're waiting for the markets to just do all this madness. So you see that while I'm still teaching all of these things, I'm giving you your free ticket, your easy way out, okay, to stop dealing with lower time frame and all of those, because you see, it takes a lot. And you can see here in this response, I'm profiling the markets for an intraday trader. So as an intraday trader, I know that, London session is not high probability, but if I'm executing in London, I'm obviously using a higher time frame stop loss, so the markets can do whatever it wants to do. Now, the solution is to engage from the 4-hour as a short-term trader, or wait till New York and frame your setup intraday. There's a risk of completely missing out, and this risk is, it's just from experience. The periods, I'm waiting for the New York session, and just prior to New York session, the markets runs away again, or possibly I didn't get any setup that I'm comfortable with, right? And I don't get in, and the market still expand, and I'm like, oh, but I was shown bias. You're shown bias. You saw the 4-hour time frame validated the bias. Why didn't you go in? So you can see that it's all of the things I talk about is from personal experience, really. And I don't think there's really any other way other than these things we talk about, really. I don't think so. And the person said the dynamism of the market. Yes, really. I don't know why I didn't like this then. You understand? It's the dynamism of the market, and that's market profiling. You're looking at one session to determine if the next session is high probability with respect to the drawn liquidity. So now the next thing, after we talked about what market profile is, which is current market data, we define what market profiling is, which is using that data to define if a move is likely to occur. Now, we also said, what are those data? For example, we ran through those data, And now that we have the data, now how can we evaluate high probability conditions in intraday? Now, before we can evaluate high probability conditions intraday, there is something we want to discuss first. Okay, I always say it comes from top down. Yeah, top down, right? Yeah, of course, it comes from up to down. So if up isn't doing so well, you have no business down, right? And that I'm still going to make reference to a tweet I shared yesterday. But first, before we can evaluate for high probability condition, I think the first thing we want to notice, if there's high probability trading condition, it means there are low probability trading conditions. And it means if we can identify low probability trading conditions, we have automatically defined a high probability environment, right? Does that make sense? Now, I'm going to go through a list because I made a list. Okay, you have to do, that's how you prep for presentations, like especially something as bogus and bulky. For those people that might be interested in, maybe making contents like this, you need to write. All right, I don't know how. I have to write my thoughts down. I'm not getting any of this from anywhere. It's from personal experience and the knowledge from from ICT, right? All of the knowledge down, the practical application of those knowledge is what I'm giving. And that's what my mentorship is. My mentorship isn't for you to go there and think that you have to figure out something else by yourself. No, that's not what it's for. I've laid everything bare for you. You just follow it. You can optimize it here and there. It's fine. Okay, but if you want to add to it, well, why go through that stress? Because it's proven and it works. And I share it on a weekly basis online, and you see it works really. So what do you want to do? If you really in this business to make profits, you want to be profitable quickly, I think if you don't want to go through the stress people like us went through, I think you just listen. Okay, you just listen. There is no flex in trying to go through pain, like as though it were like a badge of honor. You understand what I'm saying? So how can you identify low probability trading days? Because if I can evaluate if a particular trading day is low probability, okay, it means I can now have sifted out the negative periods I'm likely to take a loss, because taking losses isn't just only about doing dumb shit or being wrong or biased. Okay, there's a way to manage risk by evaluating market conditions from the higher time frame. That's risk management. Okay, it's always risk management. But first, you have expectation and risk management in terms of what is the current climate showing. Is it highly in my favor or not? If it's not, I sit still. I'm not in a hurry. I sit still. Okay. So the first one, Monday, and someone like, what did you just say? Yeah, Monday. Low probability, really. For example, if you look at GJ, for example, if you're bullish on the weekly time frame, let's look at the weekly time frame, because I've been eyeballing GJ to return into this gap. Okay, you can see this gap. I've been eyeballing GJ to return into this gap. This is a drawn liquidity. Why? We're trying to sell side here. There's a low here, a lower low, and another low here. This is 3 drives, and 3 drives are usually reversal patterns, especially when it aligns with the higher time frame institutional order flow. Now the question is settled: does this align with the higher time frame institutional order flow? Yes. Why? Because dollar index is bullish, and if dollar index is bullish, it means USD JPY is bullish, and if USD JPY is bullish, it means GJ is likely to be bullish. Why? Because they are closely correlated pairs. Does that make sense? So you see, GJ is directly linked to the dollar index, but the bridge is USD JPY. Well, I think you should write that down. So this is drawn liquidity on GBP/JPY. Okay, if you contrast it with USD JPY, you see USD JPY has been bearish, responding to DX, where this just stayed in consolidation because I think they've met objectives they want to meet, and markets are just waiting for dollar index to validate, and then this one can start running, right? I think markets are going to run these highs, at least completely close this gap first, and when they invert this fair value gap, we can begin looking for markets to trade these highs. I can't help it. That's some commentary. So Mondays, okay, yeah, I was talking about Mondays trading because if you're bullish this week, why are you bullish? This is a drawn liquidity. You might have the expectation for the markets to return into this low first. You can have that expectation. Is there anything wrong? No, there's nothing wrong. There's nothing wrong having expectation. But what you should know is that the drawn liquidity is more important than your expectation. I don't mean your expectation in terms of bias, your expectation in terms of how the markets are likely to deliver that bias, because markets can deliver that bias however they want to deliver. So the drawn liquidity is more important than what? How markets are going to trade into the drawn liquidity. So you just wait candlesticks, look at, study each daily range. And this particular day, you might be feeling like, okay, you see, this is low. You're probably thinking, I think this is not the previous low. Let me just annotate it so that we're seeing it as we ought to see. So here, and if you've been staying with me for a long time, you understand why I'm saying the market's running, because this is indecisive. When market doesn't trade outside of the previous candles range, it's indecisive. And if you have a bias, you'd like them to take out sell side first, then run for buy side. Okay, so when they take out sell side, you look for market structure shift in line with your drawn liquidity, engage, hold. That's a model. So on daily time frame here, so this is daily time frame. So you see on the daily chart here, this is the previous week low and Monday trade bearish. You might be thinking, oh, since Monday is bearish, Tuesday is likely to be bearish also. Yes, Tuesday was bearish. And where was Tuesday bearish into? Into this low here. Not. And when Tuesday trade here, probably at the peak when Tuesday got here, you'll be saying, oh, probably there's a markets could trade here and stuff. But market didn't close inside the range of Monday, right? Validating the weekly bias, and GG has been bullish since. So Wednesday, high probability. Thursday, we'll discuss Thursday, not high probability, because what? Market trade objective. It's only high, it now became high probability when there was a forward change in state in delivery and after market trade into the order block. But we're going to get there. So Monday's trading, low probability. When you have a bias, wait for Monday, especially if you're short-term trader. Wait for Monday to show something, because you need Monday to validate the weekly bias. You use sessions to validate the daily bias, because each candlesticks, each daily range contributes to the weekly range, and each session contributes to the daily range, and each weekly candle contributes to the monthly range. That's how you want to think. So if you're bullish on the monthly time frame and a single weekly candle was bullish, that's validation of your monthly bias. So automatically you want to go in the next month and the next week bullish. That's if market hasn't met objective. You want to note. So how do you identify low probability trading days? Well, Monday, low probability because you want to wait. The next one is during holidays, because liquidity is thin in the markets, and I think a lot of people don't really believe or trust the things they say. A lot of people talk about liquidity and then they trade on bank holidays. If you really talk about liquidity, why are you trading bank holidays? Because liquidity is thin. The people that move this market on holidays, what are you doing? Only few speculators are still in markets and stuff. The markets try to move, but it's likely to be in consolidation. So why should you trade then when there's this little liquidity in the markets? Why would you want to do that to yourself? So after a large range day, probably driven by news event, sometimes, that's low probability, because, for example, this is a large range day. Okay. The next day, like I even said, is low probability, because whenever there are large ranges, sometimes you're not taking into account. Large ranges tend to hit objective. Okay. And if large ranges meet objective and you're going, sure, it's low probability really, because you have to have a reference point of a key level, because they're likely to return into the range after a large range day. So when you return into the range, you need market structure to re-establish, probably your daily or your weekly bias That's if your target has not been met yet. So when markets hit a high time frame opposing PD arrays, maybe a daily, weekly time frame, the subsequent day or week or session is low probability. I'm going to go through it again. First up, Mondays, you want to know that. During holidays, you want to note that. Then after a large range day, sometimes, after markets, after news events, okay? Because if we talk about the average daily range, whenever news events expand so much, they probably exceeded the average daily range and is likely to be low probability. That's why sometimes NFP runs about 7 pips and rejects after because they met the average daily range. And now, they are trading in the opposite direction. So those are the subtle nuances you want to note. So yeah, so sometimes, large range day overlaps with market hitting a high time frame opposing PD array, okay? Because large range, markets hitting markets the exact trade here, almost shy of about maybe 2 pips or so. Okay, markets didn't hit it, but say market hit it, you can see there's likely to be that rejection. Okay, and for example, what if the market is bearish and you don't know that the markets are bearish? You think markets are bullish, but you understand markets are going to trade you first. Markets can literally reverse from here. So imagine going in again, oh, this candle is green. Settle said when you say green candle is likely to be bullish, but you didn't say Settle said when markets meet objective, you are going to wait. All right. So the final one is during decoupled conditions. For example, that's cracking correlated assets and stuff. The reason why I've not been speculating on GJ for a while is because USD for example, has been trading lower, and it makes sense for USD to trade lower, okay, because the dollar index is bearish. But then again, I know and I think GBP is bullish because of the 3 drive. So USD just stayed in consolidation. So that's a decoupled event when GJ is trading lower, and that's an SMT too, if you want to note, because when GJ was making lower low, when USD made lower lows, GJ has made higher lows. That's SMT. Do you understand? That's SMT. So during decoupled conditions, I don't want to do anything. And how do I engage that? Okay, markets are no more decoupled market structure. You can see here we had an old volume imbalance, and market has been consolidating inside this volume balance. Okay, they closed here above here, trading to the rejection block, closed above, made this down candle, and ran through here high resistance because markets already traded above this level here. So this low here is high risk. Market ran below Tory soup and stuff, and now that markets closed above this inversion fair value gap and above this down candle, this is a change in the state in delivery. When markets closed above the bodies of this candle, the open when this market, let me show you clearly because I'd have to be talking about change in deliveries really every week. This down candle here, as soon as the market closed, it doesn't have to be exaggerated like this. But as soon as the market, it could close by a pip, 2 pips. But as soon as the market closes above the open of this candle, that's a change in the state in delivery. So you can see markets are utilizing resistance level here and for support. Now, since market met objective here at this fair value gap, they are likely to return into the range. And market did that into this key level. So this is a buy, right? So your focus as a developing student should be taking setups towards the high time frame drawn liquidity, not after markets get into the drawn liquidity. Okay, how you take trades is towards the drawn liquidity. Okay, and drawn liquidity could be you can define it in terms of market structure. You can also define it in terms of the high time frame institutional order flow. Now, you are not looking to take trades after market hit objective. It could be previous this high, it could be previous this low, it could be fair value gap and imbalance like this. Okay. Now, you are not looking to take trades after, like I said. Now, this inclusive of appropriate conditions, the appropriate conditions, like as a developing student, you want to be taking trades towards the high time frame draw on liquidity. Okay, and you will not put into consideration low probability trading days, because if you can define the draw on liquidity and you can filter days you're likely to be wrong, for example Monday, okay, this is how you find low resistance liquidity run setups that won't stress you. Okay, that's what low resistance liquidity run is. Easy setups, they won't stress you. They might probably stress you intraday, and that's why I don't like intraday, and that's what I'm trying to tell you. Trade the 4 hour first, find consistent profitability on 4 hour first, then go intraday. Don't try intraday first. Intraday takes years to master, and you can see all of these details is from my 6 years of trading. Okay, so now imagine someone just got in trading this year and think they're going to master day trading this year. No, it's going to take you years, and that's what it is. So if you want to cut corners, trade the high time frame first, gain consistency while you master intraday tools and templates. And these are tools I'm giving you for intraday trading, because everyone here knows how to take profitable trades. That's the truth. Everyone here has a model. Now I'm teaching you how to put in your models in right environment so that it can flourish. Because if you're putting your models in the wrong environment, you just be taking consistent losses, and then you think your model doesn't work, and then you move from one strategy to the next strategy. But the people teaching you strategy, they're not teaching you to place the strategy they taught you in the right trading environment. They are just teaching you strategies and stuff, and that's what it is. So you have a strategy. I don't know what it is, okay? But I'm telling you that go to your charts and look at periods your strategy failed and contrast it to the things I'm talking about. And you're going to see it clearly. It's as clear as day. Because you're going to take into account PDRs, support and resistance level. Markets will not trade into a resistance level, and you don't expect the markets to react from it. It's just basic knowledge. Even if you have a bias, your bias doesn't mean shit. Markets will respect these levels. And that's why there's a lot of patience in trading. You have to wait for markets to respect this level and re-establish that bias, and then you re-engage. So we define low probability conditions. We talk about Monday, we talk about during holidays, we talk about after large rain days, especially if it's sponsored by news event. It doesn't really have to be news event, but most especially when markets hit a high time frame objective, okay, after a large range day. And also during the coupled events, when two closely correlated assets are in trading alike, that's low probability. Okay, it's low probability for one, and probably the other is just maybe reaching for trying to manipulate, because that's the only reason why markets will decouple, and that's the only reason for SMT. Now somebody asked me SMT today. They said, oh, so what's SMT? And I said SMT is with respect to you want to frame SMT with respect to the drawn liquidity, because first off, what's your bias? What's bias? And then you want to see how market structure reflects it. If, say, like I said, we are high time for institutional order flow, okay, we say it's bullish. See, USJPY bullish, but USJPY has been trading lower. For example, between this candle 11th of April 2025 to 22nd of April 2025. This is 11th of April 2025. This is 22nd of April 2025. So USDJPY makes a what? A lower low. What are we going to say about markets running, this low and this low? Let me make it thin. Market ran this low, but we think USDJPY is bullish. Market ran this low again. This is manipulation, but also it's decoupled, because GBP/JPY is showing strength, relative strength, compared to what? USDJPY. And this is manipulation. because what's the higher time frame institutional order flow? Bullish. But then again, now we're seeing something different. We are now seeing a change in the state in delivery here. And what's this doing? This is validating what? The higher time frame institutional order flow. Are we saying USDJPY is likely to be bullish now? Yes, that's what I'm saying. So you can see how they are decoupled events, two closely correlated assets. They're not doing the same thing. It's because one is manipulating and the other is reflecting high time frame. Because if GJ is failing to take previous low, that's a bullish market structure. Remember, this low was what? The previous weekly low. And if each weekly candle stick reflects market structure, it means in a bullish environment, markets aren't supposed to ideally trade below previous weekly lows. Do you understand? In an ideal environment, markets aren't supposed to trade previous weekly lows below. Can you say it? Markets are maintaining previous lows. But whenever they trade below previous lows, that's a turtle soup. Does that make sense? Because this lesson is just supposed to be about evaluating lower time frame probability, but I'm saying a lot of stuff because I'm trying to answer as many questions as possible. A lot of questions are being asked, and I would really appreciate if folks are really, taking notes of these things, because it's not really encouraging to say something and have to say them again and again and again and again, and the stuff you've said before. That's why these things has been said. You have to take notes and you go back to your notes, because majority of your question has been answered already. But probably when you're watching, maybe your mind wasn't just there at the moment, and then you skipped it, and then when it comes again, you're like, I don't know about it, was said already. You need to pay attention. So now that we've defined low probability trading days, now it means when markets are yet to hit an opposing liquidity pool, that's high probability condition. And when markets are keyed off of a level and markets are showing sponsorship, okay, I think on this brokerage, GG didn't trade below that low and is actually fine. Whether it trades in this low or not, it's really fine. I really don't care. It can do so on our brokerage, because we're beginning to see there's just too many disparities in forex. This brokerage is doing this, that brokerage is doing that. I don't care. What am I focused on? This daily closure. Like I said, how the markets will deliver is less important than the draw on liquidity. Okay. Now this is Tuesday, validating the weekly bias. What is the market likely to do on Wednesday? Trade in line with the weekly bias, of course. So that's what I said. When you're profiling markets, you want to see time of day, you want to see session, you want to see day of week. This is how you want to profile markets. If I'm bullish and market did this on a Tuesday, well, Wednesday is likely to be bullish. That's market profiling on a daily time frame. Like I said, this video we're going to lower time frame. That's where the business is. So evaluating high probability conditions. Okay. For a start, when market key off of a level and show sponsorship in line with my bias, that's high probability. If we haven't traded into objective, that's high probability. It's as simple as that. We keyed off of a level. Now it will be the rejection block or the previous daily low here, or this order block here, because this is an order block. It's not a fresh order block. So you can see it works. When markets consolidate, they can stay on a key level for as long as possible. So this is an order block, and markets are in this order block. So the key off of a level order block shows sponsorship in line with the weekly bias, and this is just Tuesday, so Wednesday is likely to be what? Bullish. That's all. They met objective, and this is where intraday trading comes in, because talking about it like this, I'm just discussing high time frame. So now let's go intraday, because we want to evaluate for high probability intraday trading. Okay. So high probability intraday trading. So first off, we must determine if that specific day is low probability. So what I'm saying here is that before, how we determine high probability intraday trading is first defining if that day is low probability or not. If you go through the checklist, all right, and see that that particular day is high probability, then that's a high probability intraday day. That's high probability intraday trading for you. That's it. And the next one is the 4-hour market structure. How is the 4-hour market structure? Is the 4-hour market structure in line with bias, or is the 4-hour market structure yet to be in line with bias? If 4-hour market structure is in line with bias, then intraday high probability. Okay, for example, if we take Tuesday's trading, for example, and we saw that Tuesday traded, Tuesday traded below Monday's low. Here it is, Monday's low, and you can see Tuesday market closed here above this candle. You can see market closed above this candle. That's a change in the state in delivery in line with what your weekly bias. Market may have traded into an old high here, which is a draw, a near-term draw, a minor buy-side liquidity here. But this doesn't mean from your market is going to reverse. Even if market rejects like this, I don't care, because I'm looking at the daily time frame and seeing how the daily time frame closed with respect to the weekly bias, and I'm only waiting for markets to return back to these consecutive down candles. Now you can see how the bodies of the candles respect this down candle, and this is how, now that you have a key level here, you want to see how market trades in each session, because now 4-hour time frame market structure is in line with the higher time frame bias, right? The daily time frame has validated the weekly bias based off of this candle closure, right? So this is high probability condition because we've not met the weekly objective yet, and the daily time frame has validated the weekly bias, and we've not even traded into the weekly fair value gap. That's where this partial is. Okay, that's where the partial is. Okay, because I've been stalking GJ trying to take my trades, and I was already planning to take partial profits here. Why am I planning to take partial profit? This is that weekly gap. This, the entry into the weekly gap. This. Okay, so I was planning for partial profits there. So that being said, next thing is the sessions. Okay, now this is where things are getting a little bit crazier. I have to put the daily divider here. Now, on this particular day, that's on Wednesday, what happened as soon as markets opened? Market sold off. Why did market sell off? Market traded above buy side liquidity. Is this expected? Yes. What's your next thing? Key level for time frame breaker. Now, does it mean the markets cannot have a drawdown here? Of course, the markets can. Because if we go through lower time frame, someday we can put into consideration this fair value gap here. Is it possible market trades it? Yeah. But look at where the bodies of the candles are settling. That's what you want to know. That's why it's a key level. That's why this is not a key level. That's why this is the key level. Look at where the bodies of the candles are settling. That's how you identify key level. For example, when you look at daily time frame, you can see we have a daily order block here. And when you go through the 4-hour time frame, you can see how the bodies of the candles traded around the order block. You can see the bodies of the candle. That's how you define a key level, really. What's a key level? An order block or a breaker. This is a breaker here. If I anchor this here, this is a breaker. We have liquidity here, markets around liquidity, and broke above. This is a breaker, an order block, right? That's a key level. Now, can market return into this inefficiency? Yes. Can you go in looking for trades as soon as the market traded here? Yes. I mean, if you were lucky enough not to probably set your limit, I mean, because we are dealing intraday trading now. So I'm not going to be talking about executing here. So market trading Asia sold off. If your daily bias is bullish, is London session high probability? No, London session is not high probability. Why? Because each session contributes to the daily range. So if Asia was bearish, London is not high probability, because you need something to validate that bullish bias. And what do you need now? You need market structure. So markets now traded sell-side trade to our inefficiency and stuff. And this is where a lot of people, say this is your actual liquidity. Stop that shit, man. Stop it. Not everything you're trying to teach how to identify the real. Okay, what if the markets rallied from here? What are you going to say? You come out and say, oh, markets didn't go into my liquidity and stuff. You see, it's not consistent. I'm teaching you how to read price action and know when something is likely to happen and when something isn't likely to happen. So if Asia session is bearish, you can't go in London session as a day trader, because you need market structure to validate that bias. And since it's the daily time frame you have your bias, you're looking at 15 minutes, 30 minutes market structure. The only reason I'm going to 30 minutes and 15 minutes because it has a more cleaner, market structure. And you can see here, market traded into the 12 fair value gap, which of course you can also execute from directly on the higher time frame. But as day traders, always wanting to manage risk and stuff, and you can see here, this is where it happened, where there was a change in the state in delivery. Can you see? When market closed on this candle, I would prefer it to reflect the 30 minutes time frame too. Okay, this is reflecting 30 minutes. In fact, 30 minutes already had an early closure. That's good. So when that happened, and this happened around 5:15, so it means, okay, two things are going to happen, because as day traders, you want to be trading at key time of day, or say during the kill zones. And the kill zone is between, for London session, we have London session kill zone 1 to 5, but within the kill zone, there is ideal time of day. And that's a very special lesson. Hopefully I'm going to teach it or not. I don't think I will, really. Anyways, because that's supposed to be a lesson on time and price, but I don't know if I'm going to teach it. I'm not willing to teach it. Okay, I'll be honest with you. I'm no more willing for some reasons. For some reasons. Yeah. There are a lot of thieves online, so I'm not going to teach it. I'll just keep it. Yeah, that aside, so you can go in at key time of day, okay, but for someone who has waited for long, you can, as soon as this candle closes, you can buy it and place your stop loss here, or say maybe 5 pips below. And someone says, oh, Cero, the stop loss is large. Well, there'll be trades that have minimum 67 pips. That's insane. Although if you mirror it to your objective, you can see it doesn't mean anything, but the drawdown is going to be crazy on this particular setup. But if you're trading at key time of day, or say during the kill zones, you have to wait for New York session, and New York session is between 7 o'clock to 10 a.m. right? So you want to see how market structure is playing out. So this is 7 o'clock. Market is selling off, and market trade into the rejection block. I think this is the best the markets can offer you. Literally, this is the best, because this low here is invalidation. Why is it invalidation? There's a change in state in delivery, meaning the daily range is willing to expand, or the daily candle now is willing to expand in line with the weekly bias. So this is your invalidation for intraday trading. So you can project from low to high and trade at discount during the kill zone. And this is 61.8%, and this is where the market is at during the kill zone. Okay, and you can just buy and place your stop here. That's how I didn't want to mention the kill zone because it's not in this lesson, right? But I think since I'm not likely to, I don't know, I'll teach the kill zones. I'll teach the kill zones in a separate lesson. Yeah, I'll teach the kill zones, but not ideal time of day and stuff. So here you have about 34 pip stops, and that's what the markets are offering. And you have to place your stop there. And if you're not content with that, then I'm sorry, then look for someone who's going to teach you how to buy exactly from this low. I'm not going to do that. Okay, and that's the reason why a lot of folks cannot make money in Forex, because they can't think that the markets can actually give drawdown on their entries, which doesn't make any sense. The markets are effing probabilistic. Anything whatsoever can happen. And there is another entry here. You can see as soon as the market closed above this candle here, I don't know, I think my network is very ishy. I'm having terrible network at the moment, so it's kind of like insane. So it means I'm just not going to go through, I'm not going to change time frames anymore until my network comes back. That's crazy. So when markets closes here, you can buy this candle. This is still New York session, 9:45, and place your stop here and allow the markets to do its thing. Okay, that's evaluating, lower time frame. And if we look at the setup from yesterday, it was literally the same thing. Okay, market met objective on daily time frame. I cannot check daily time frame because my network is down, and markets traded lower overnight and traded into, yeah, I think my network is back, thankfully. So and market ran to objective. And what's this objective? Recall this level here, the weekly gap. Yes, that was objective. So market ran into target, and we're seeing the market return back into the range. Now, because the Asian session is bearish, we're going to apply the same tool here and wait for London session to validate that bias. And as soon as there was a change in state in delivery, I bought, and when markets returned back into rejection block, I bought somewhere else again, right? And this entry here was insane, the rejection block. Now, do I know if the markets are going to trade to rejection block or not? No, I do not know. I just follow the model and place my stops and wait. Okay? And that's how you want to profile markets. You look at the previous session and you use it to think of how you're going to engage in the new session. For example, today's trading or yesterday's trading GBJPY, we had expansion overnight. And because we had that expansion overnight, okay, Asia is bullish. Well, London is low probability because GJ traded and closed a daily fair value gap. Okay, I'm going to show you here. There was a daily fair value gap. Remember I talked about market meeting objective. When market meets objective, so we have to put that in consideration. So you can see market in London session, market met objective, and market stayed in what? Consolidation until what? The New York session. This is 8, and market expanded. But why is New York session likely to expand? If you check the 60 minutes time frame, okay, if you check the 60 minutes time frame, you can see this down candle here. You can see this down candle. If you extend it, you can see this candle closed. This candle closed at the bodies of this, at the open of this candle. That's a change in the state in delivery, meaning the hourly time frame has realigned itself with the daily bias. So when markets will be making a retracement into the range, you can capitalize on that for longs, and that's essentially the post it was this longs here I posted on Twitter saying, happened during, London close ish, as a pre-New York session ish. Okay, so that was it. Markets consolidating on a 4-hour level, and there's one low, another low. There's a 3 drive, a chain is dating delivery, and an entry. That's what it is. It's the same thing, really. It's the same thing. So you can see when markets just stayed in consolidation and New York markets just expanding, I wouldn't care about all of these things, because as soon as market traded below sell side here, and there was we can see chain is dating delivery, you just buy it, place your stops under, and wait. That's how you do it. You buy it, place your stops under, and you wait. And market was a couple pips shy of target. But imagine I didn't collapse my trades. I would have given back 50 pips. And it doesn't make sense, because I was looking at this consolidation and said, this doesn't make sense, very close to my target. And I have to collapse my trades, right? So I'm so exhausted right now. And we can see on this profile, we can see expansion, consolidation, expansion. Why is New York likely to be an expansion? Market hasn't met objective. Why is London likely to be an expansion? They met a near-term daily time frame objective. Why is Asia? Why was there an expansion in Asia? I posted my charts on Twitter, and I was talking about the change in state in delivery here. I was talking about change in state in delivery on GPY, and this was just before markets close. Okay, that was just before markets close. Okay, as soon as this candle closed above, I told you there are 2 ways you can go in when there's a change in state in delivery. You want to buy the next candle, or you want to wait for markets to return here. Now, if they create a fair value gap, the fair value gap takes priority before this down candle. Either you buy here created a fair value gap, you want to buy a fair value gap. If there's no fair value gap and this candle just return back, probably after this candle closed markets, you can see if the markets will return back here. But the markets didn't. Markets created a gap, so you buy the gap. That's what it is. So while markets are in a key level during the Asian session, what do you think the markets are going to do? There's a high tendency that the markets are going to expand, because markets are already key enough of a level, and there's a draw on liquidity to meet. I said the Asian, the London, and the New York session contribute to the daily range. And this is just one case study. When you watch this, look at your charts, look at objectives. You can see I called out an objective, a systematic objective here, when I was looking at the close of this daily fair value gap. That's an objective, because markets just rebalance an inefficiency. Don't you think the algorithm is going to want to react from this? See, the devil is in the details. You have to be able to look at the details of price, because if you don't see the details, well, you won't make informed decision, and it's a lot of work. And that's why the downside of high performance like this for me is that I'm usually restless. It's always very difficult for me to settle my mind, because I exert myself so much looking at details in price action, and that's what I'm trying to inspire in everyone listening here. Look at the details in price action. Okay, that's where the source is. Think about it. Each session contributes to the daily range with respect to what? A key level and a draw on liquidity. But along the way to that draw on liquidity, you might face a series of resistance levels, and you need to be aware of them so that you can be able to manage your expectations within each sessions. So Asia could consolidate. Asia could trade against the high time frame bias. It doesn't mean anything. What do you need? A key level, bias, draw. If you're day trading, you want to see how the next session, tells you, what's likely to happen next session with respect to maybe the average daily range. Because if markets have traded into objective prior average daily range, markets are likely to stay in consolidation. Look at dollar index, for example. Dollar index traded above previous this high, and because of that, yesterday was a very serious demonic consolidation. All right, you want to think about it that way. But then the dollar index expand overnight. Yes, it did. Does that validate the daily bias? Yes, it does. But what happens throughout? Well, they stayed in consolidation. It could be, it's Friday and we don't have any more business again other than previous days high. Well, that's market. There's nothing you can do. So I hope you found this one insightful. And if you manage to get to the end of the mentorship, congratulations to you. I'm trying to get to 1,000 subscribers on my YouTube. Don't forget to like, comment, share with a lot of people, spread the word, and let a lot of people get on this, because this is crazy stuff. Yeah, this is crazy stuff. You need to watch it a couple times. And I'm so exhausted, and I wanted to cover more examples, but I think GJ is fine. We did 2 examples on GJ, and you can just go on repeat. And yeah, so until I catch you in the next one, be safe.